Good morning, ladies and gentlemen, and welcome to another Irwin Mitchell webinar. During this COVID season, we're delivering these seminars to reach out to our clients, contacts, communities, our friends, to really deliver some information, some guidance on what we hope are topical and interesting conversations for you. Thank you for taking the time and trouble to join this morning. For those of you who don't know me, my name is Zara Pabani, and first and foremost, I'm an ambassador for Irwin Mitchell. I'm also a family law partner, and today my role is to be your chair. We're talking today about managing your finances in periods of uncertainty. Now, it's all about money and what we do with our money, how we look after it, are we paying attention to it? And I'm joined today by two speakers, Richard Potts, who is the Chief Executive of IM Asset Management, and David Gooding, who is a financial planner for IM Asset Management. And I'll be speaking to these guys and really getting some insight into what's happening at the moment, and hopefully giving you all some helpful hints and tips about what to do and how to do it. We're all about sharing information, and together we're stronger if we do that. That's what we believe. Now, this is your webinar, so please use it as much as you can. There is a Q&A panel, so ask as many questions if you like, or make observations, or if you want us to cover a specific topic during this hour, then ask us to do so, and I'll do my best to accommodate all requests. We'll probably do question and answers after about half an hour or so, but please do feel free to join in the discussion. Also, we would ask you to fill in a feedback form, and that's going to flash up soon so that you can fill it in before you leave. These webinars are also recorded, and we'll send you a link to it afterwards as well. But that doesn't mean you get to leave us right now. Stay with us. I know it's a dreary, wet Friday, but people, the sunshine is coming. It's there. It's on its way. But for now, why don't you stick with us and listen to our discussion? So, David and Richard. Richard, let me start with you. So you're a very important person. You're the chief executive of this company. Tell me a little bit about you and this company.
Thanks, Zara. Yes, and thanks for the introduction. So I'm Richard Potts. I've been at Irwin Mitchell, the asset management part of Irwin Mitchell, for the last 17 years, pretty much from the beginning of the company's history. The company was set up very much to support our colleagues in the personal injury teams and the corporate protection teams dealing with their clients who had very specific needs following on from serious accidents and the awards of large amounts of compensation. Building on that basis, though, we've recognised that there are many people in the broader community who can benefit from our approach to planning, our approach to client service, our approach to investments, and so we've expanded our offering so that we can bring the skills and the services we have for the personal injury and corporate protection clients to the more general client area, and that's very much the area that David focuses on. Many cases there are differences between the needs of those kinds of individuals, but it's surprising how similar people's needs are, and at the end of the day, people really just need a very, very good financial plan that's constantly updated to make sure their needs and aspirations are realistic in the environment they find themselves. And I think now that is more so than ever.
That's great. That's really helpful. Thank you. Now, David, turning to you. So you're a financial planner, and there might be some people who don't even know what that means. You know, tell me what you actually do and who you are.
Sure. Morning, everyone. A financial planner will give advice on pensions, investments, insurance, but the main part of the job really is to sit down with clients, although we're not doing a lot of that at the moment, virtually sit down with them, I suppose, and understand what their future financial goals and their needs are. So it's working with clients to understand where they want to get to in the future, and then discussing with them how to get there in the most tax efficient way, the most efficient way for them. Okay. And so it comes back to what Richard was talking about earlier, about having a plan for clients. That's what we do, really.
Okay, that's
I
really
mean,
good.
Sarah, can I just emphasise one point of that I think is really important about what David does, is because all of this sounds very abstract. You know, we need a plan. We're talking about many years hence for most people, about an income that they don't really know how much it'll be. And one of the great things David and his colleagues can do, and our other colleagues in the sort of corporate protection, personal injury part of our business, is they actually produce a chart saying, on these assumptions, on this cash flow requirement, you need this amount of money to generate the kind of income that you are looking to achieve over the next few years. And we can change the variables and we can put in different scenarios, but it really brings to life a person's financial needs and really helps them focus on, yeah, I need to do this, or that's unrealistic, or if I want to do that, then I'm going to have to do this. And it's a really powerful tool, and most powerful when you update it on a regular basis, so annually, which is what, you know, our advisors do.
Yeah, okay, all right. So, but right now we're in this COVID season. I mean, it's all different. And from a legal point of view and many other points of view, lots of people just froze. You know, clients didn't immediately want to do anything. Some people had to continue doing things, but in this environment, people have just had to stop and look after their kids, really. That's probably the primary concern for lots of people out there. So can you tell me, David, how have you seen clients in your industry react to this current crisis?
We've had a range of reactions, Sarah, really. We took a decision really early on that we were going to contact clients before they contacted us. That was important to us, really. Most clients, I suppose, were fairly sanguine about it. I mean, nobody likes losing money, or at least I've never met anyone who does. But most clients had seen it before, not with the speed, I don't think, that it happened, and an added factor, of course, you know, everyone's worried about their health, and we spoke to a lot of clients who were more worried about their health than they were their money. But how have they reacted? Most clients, it was a case of just reassuring them, or reminding them of the reasons why they were investing in the first place, and of the need to take a long-term view, and just reassuring them that we will get through this. I think it's an endorsement, really, of or if you take on a client in the right way, then when these things come along, it won't be a problem, because whenever we take on a new client, we always have these discussions about, you know, what happens if the market falls? How's it going to affect your plan? How's it going to affect your finances? So if we've done a proper job, then the conversations that we've just been having with clients are not difficult. We did have a few clients who panicked a bit and wanted to take the money out, or at least stop investing. But we managed to talk them out of it, and that's been proved to be the right decision, I think.
Okay, great, thank you. And Richard, can I come into you next? So talk to me about, I mean, we're in a recession. Are we in a recession? How long are we going to be in a recession? And why is this different to any other time that we've had financial difficulties in this country or in the world? And how have the markets actually reacted to this difference, to this scenario that we're currently in financially?
Yeah, I mean, I think there's no doubt it is different in many respects. It's a pandemic. We haven't really had anything like that since the Spanish flu immediately after the Second World War, and obviously, Second World War, First World War, and obviously that was a very different kind of environment. I mean, to answer your first question, are we in a recession? There is little doubt that we are in a recession. A recession being defined as 2 consecutive quarters of negative GDP growth. We absolutely are in that kind of situation. The real questions are what's going to happen going forward in 6 months, in 12 months, and beyond. And I think there is a lot of reasons for optimism. As David just said, one of our key tasks that we did at the very beginning was to get in touch with clients, and we took the view that two things were happening that were quite positive. Firstly, we thought that the disease was going to result in deferred demand rather than destroyed demand, whereas in 2000, when in the immediate aftermath of the Y2K sell-off, and 2008 in the Great Depression, markets saw real destruction of economic activity. And at the moment, we don't believe that'll happen. We believe that people are not spending at the moment, but when they can get out, and they will start spending again, and that's being vindicated at the moment. I mean, for example, this morning, UK retail sales were down, but they were not down as much as expected, and they are showing real signs of bounce back. And we've all seen the queues for when Primark opened, and this is a trend that you're seeing throughout the world. I mean, the US retail sales were pretty strong, the French retail sales are pretty strong. You're seeing demand pick up in other parts of the world and for other areas, and companies are coming out and saying, yeah, it's bad, but it's not as bad as everybody expected. But it's not great. The other thing was, and I think this is really the important thing, and I think this is what financial markets are focusing on at the moment, and that is the response of the central banks throughout the world. It has been nothing short of remarkable, but actually it's not that surprising that they reacted in the way they did. I mean, the US, that has been very much in the vanguard of this, produced a note, timely note really, a couple of weeks before, saying this is what we will do differently in any economic meltdown. Now, I don't think they thought it was going to be because of the pandemic, but they certainly were aware that there were pressures on the global economy before the pandemic hit. And what they did is they introduced far more quickly than they've ever done in the past, and in much greater measure, huge amounts of money and liquidity being injected into the system. They didn't let interest rates rise. They told the markets that they were going to keep adding liquidity to the market. They got support from governments in terms of getting money directly into the pockets of the consumers. So fiscal policy has supported monetary policy, to use a couple of technical terms, and that really is supporting the economy, supporting the markets. And I think it means that the austerity that was the policy for 10 years up until very recently is certainly a thing of the past. And what we're going to see going forward is much greater fiscal intervention, much greater loose monetary policy. And in our view, that's probably inflationary sometime down the road, but that's a couple of years away. For the time being, we think financial markets are right to react positively as they are doing, and we're certainly feeling at the moment vindicated in being pretty optimistic about financial markets. There was a period in late February, early March where it was tough, where markets were falling precipitously, but we took comfort from the really positive response from the authorities around the world, and that remains in place, and we don't think it's going to be lifted anytime soon.
Okay, thank you for that. So let's move on to well-being. That is the hottest topic around at this moment in time, quite rightly. People's physical well-being, but very much their mental health. And when I talk about mental health, I'm not just talking about people who need to be on medication or who need counselling and support. All of us, we're all being affected in some way, shape or form by the fact that we're all glued to these screens all day long and forget to walk out the door. Forget that there is a world out there. So well-being is really important. From a legal point of view, well-being is so important. So David, tell me, from a financial point of view, why is well-being important, and what does it mean when we talk about financial well-being?
Yeah, well, I mean, it is a hot topic at the moment, and a lot of employers are getting more and more interested in financial well-being, and you can understand why. There was a survey recently that said that 35% of people have been distracted because of money worries from their work. 1 in 10 have had time off work because of financial worries. So there's good reason to be talking about it. What is it? Well, we we've done recently a few seminars to companies on financial well-being, and we've covered some general financial planning and legal planning aspects. What's been interesting in doing the seminars is, firstly, they're really well attended. So most people have got this on their mind. You know, they want to come along, they want to sort it out. The other thing that's been really interesting is that most people don't have a good grip on their finances, just basic stuff, basic financial planning. And I do think there's a bit of an education gap there with a lot of people, what they're looking for is just to have some kind of plan. We keep coming back to, don't we, this need for a financial plan, but I think it is the reason when we talk about financial well-being, I think it is the reason why some people get stressed about money, is that they don't really know whether they're saving enough for a retirement, you know, whether their savings are enough, whether they're living within their budget. I think it's just basic stuff like that, Zara, really.
Yeah, that's
sorry, Zara, can I just add to that, because I think it's a really important point, and it's related to what I was saying earlier in terms of the actions of the authorities to drive down interest rates, and I think linking it into David's point about the plans. Many people have plans, financial plans for the future, will be built around an assumption of the kind of returns that they can get, and part of that will be based on the kind of returns they can get from investing in fixed income securities. Now, up until recently, that was a reasonable approach, because you could get 2% kind of return annually on a good investment grade fixed income security. But the consequences of the actions by the central banks throughout the world has meant that those kind of returns are no longer available. And so actually, if you were to invest, for example, in the UK government debt, you will be getting a yield of 0.2% for the next 10 years. Now, if you built your financial plan around an assumption of a higher rate of return, let's say for the sake of argument of 2%, but actually it's now 0.2, and that's going to be that level for quite some time, your financial plan needs fundamentally reviewing, because that is going to compromise your ability to generate the kind of returns you need. So, now more than ever, people need to review their financial plans, and if they haven't got one, they need to get one in place.
Yeah, and thank you both for that. And the thing that I find really interesting as well, you all know I'm a family lawyer, and when David, you were talking about the stress that people feel, that financial well-being stress, it affects everything. It affects your ability to do your job well. It affects your ability to partake in your relationship well. One of the reasons relationships and marriages fail is because of financial pressure, or because of dishonesty within the relationship, or imbalance of money. So I think your point around financial well-being is key, really, to the success of people fundamentally in their lives personally. Where I want to go now is, it's really interesting, isn't it? So we're in this really difficult time of COVID, and there are people who have been furloughed, there are people who have had income cuts, there are companies and individuals who are suffering financially. But also there are people who are saving a lot of money. I mean, I talked to you guys before, and I'm one of those people who doesn't really pay that much attention to my money. I'll admit it. I'll be the first to admit it. I'm a bit of a spender, not necessarily a saver. And but actually, in this environment, I kind of looked at my bank account. I thought, oh, I seem to have paid my overdraft off without even realising it. And not spending the money on expensive coffees and expensive lunches. And so there is a little bit more money there, but what should you do with it? What do you do? I mean, you just be pleased and be grateful and think, oh, well, it's COVID. I don't want to spend any more money. I just want to keep it in the bank right now. David, tell me, what would you tell me to invest money in? What is the right things to invest in right now? Particularly if you've got a surplus cash to do that. What should you be doing?
If you've got surplus cash at the moment, obviously save some of it. Don't spend it all on takeaways. It's the time to do it, isn't it? I mean, if you've got surplus cash, save some. Where do you save it? Well, I think you've got to know why you're investing. You've got to know why you're putting money aside. if you're putting money aside because you want a bit of a cash buffer, because it's emergency money or it's holiday money or you're uncertain about your job, it's got to stay in cash. It's because it's short-term money and it's too short-term to invest in the stock market, really. If it's a large sum of money and you're worried about the solvency of banks, just park it in national savings, which is backed by the government. If it's longer-term money, then you can invest in the stock market. Look at the tax-efficient things to do, like topping up your pension or putting money into your ISA. But knowing why you're investing is crucial, really, Zara. And we spoke earlier as well about people's attitude to money and why some people are savers and why some people are spenders. And we had a really interesting webinar a few weeks ago on a financial coach who was talking about the psychology of money and why some people spend, some people save. And apparently your relationship with money is formed by the age of 7. So whether you're a spender or a saver is really programmed into you from an early age. And I think you need to recognize that and know which you are. You know, I'm a saver, but I very much live with a spender. And if you're a spender, then use all of the tech that's out there. There are some great bank accounts now that will give you a breakdown of where your money's going. There are some good apps that will help you keep a track of it. So budget, you know, use what's available, budget, know what you're spending, and that just enables you to save more.
Thank you. And Richard, I'll come to you next. You know, I want to talk to you about this. Is this not really a time of opportunity? Because, you know, I do have a planner and I do work with one occasionally, even though I like to spend my money. But I'm devastated because obviously, Richard, you've told me this morning that Zara's going to be shutting its shops, and I'm devastated by that. You know, it's a time of opportunity, isn't it? So I've always learned in previous recessions that I remember when a recession happened and I was investing in a mini stocks and shares ISA, and I rang my planner going, well, let's stop that immediately because it's all dropped and it's all gone to a terrible low value. So I don't want to be putting my money in that. And I'll never forget, she turned around and said to me, yes, it's low, but markets show that it will recover. But the second point is it's an opportunity to buy cheap and make a bigger profit margin, if you like. So isn't this just a fundamental time of opportunity for some people, Richard?
Yeah, we think so. We think there's a great deal of opportunity out there for a number of reasons. I mean, I think the typical reaction of people is when they see the market falling is to sell, and because they're worried that it's going to go down further. The right thing to do, though, as history has proven every time, is to buy on those falls. And you know, there's no doubt we were shocked by the speed of the decline in February and March. I don't think we were alone there, but you know, we went back and revisited the first principles of investing, which is, you know, when everybody's selling as aggressively as they were, it's inevitably going to bounce back. So you know, I think that there is that fact of the market. You obviously have to believe, as we do, that the economic model is going to continue. We certainly didn't see any reason why it was going to change. As I said earlier, you know, we were very much of the view that it was deferred demand rather than destroyed demand. You know, we continue to be of that view. So you know, we think the economy will pick up later in the year and into next year. So you know, the right thing is to buy the dips. We think that's been supported by there's going to be this move away from austerity that has blighted too many countries and companies and communities over the last few years, the last 10 years really. We think governments are going to take a much more inflationary based approach to building economic activity, very like they did after the Second World War. This is obviously one of our assumptions. If we see that that's proving not to be the case, then we would change our approach to it. But at the moment, you know, we're thinking it's all looking good from that perspective. And I guess there's two more points there. I mean, I think the next one is there are some great companies out there that are doing really well. I mean, in the UK, Ashted is a company that we invest in. They hire out plant and equipment to people. They reported earnings earlier this week, very strong earnings, and the stock has actually risen to a new all-time high. Not bouncing back from the sell-off, but actually making a new highs. And there are a number of opportunities like that. It's a good, solid company with very good earnings prospects. And I think if we see a big infrastructure initiative, as I think is almost inevitable, you're going to see companies like that continue to prosper. And there are many opportunities like that. There clearly are many companies that are going to struggle, but there are many investment opportunities. So that's the third point. And the final point, Zara, I'd say is that I think people have to be a little bit creative about where they're going to invest going forward. There is a notion that some assets are excessively risky and they should be avoided, and with good reason. But with good investment management and good financial planning and making sure your time horizons are matched up to your investment instruments, you can take advantage of these opportunities, and we see great opportunities in the corporate debt market, where you're able to get very good yields relative to that in government bonds, and emerging market debt, complex area, but there are opportunities, and if you spread the risk and focus on a limited number of instruments, you can get yields of 4.5%. Still in that market, which, putting in that context to what you're getting if you invest in the UK government bonds, which is below 0.2, it's a real opportunity. So we think that there are huge opportunities going forward. Key areas that we're still to be decided on is, if the dollar ceases to be a strong currency, and we think there's signs that it is doing, that's going to transform the investment opportunities in Asia and other emerging markets. We think if Europe is finally starting to act in a unified fashion, as it appears to be, then there will be great opportunities to invest in European markets and European companies, which, in contrast to American companies, actually are just cheap. So the opportunities are there, and the incentive for them to actually happen is there. So at the moment, despite all the pessimism around current economic statistics and obviously the personal tragedies of so many deaths, we think there's ample reason for optimism about the future.
Brilliant, thank you. So David, I'm going to come to you next, and I want to talk about risk profile. I mean, you do this, as I understand it, when you meet a client. You talked about their risk profile. I always get terribly confused about that, and I'm one of those people, when you range it from 1 to 10, I always go kind of 5, because I'd love to have a high risk profile and not worry and just say, yeah, just be really risky and we'll make more money. But I always say, I've got a husband who's a teacher, and I say I make the money, he makes a difference, and I have a 2-year-old, so I've got lots of things to think about, and my husband has very expensive taste, so I want to buy my daughter lots of nice things. So my risk profile kind of really varies. I want to make a lot of money, but I need it to be safe to be able to provide for my family. So talk to me about risk. I mean, if we're all going to be risk averse, are we going to make any money? What are we supposed to do? I never understand that element.
Yeah, and it is one of the most important things to get right. Most people, I suppose, in common with everybody else, want the maximum return for the least risk. That's what everyone wants. The concept of risk is quite a difficult one, but it is crucial, absolutely crucial. And often people, when you ask them what their tolerance to risk is, they say, yeah, I'm quite risk tolerant, when in fact they're not. And the only way to test it really, or the way that we test it, is we've got a questionnaire, a psychometric questionnaire that we go through with clients. So we discuss with them what risk really means, and in simple terms, it's volatility. It's how much can you bear at times like this for the value of your investments to fall. If it's a low risk portfolio, it won't fall as much. If it's a high risk portfolio, it will. It's that being comfortable with that volatility or not. And if it's done right, if you get the client's risk profile right at the start, then the conversations that we've just been having with clients at the start of the pandemic are not difficult ones, because they're in the right portfolio. You know, if they're very cautious clients and they really can't bear to see the value of their investments drop, then they've been in a cautious portfolio that really hasn't fallen much when the market fell. And obviously, you know, different story for more adventurous clients. So that's what it is. It's volatility, really. The difficulty is assessing it, and everybody is different. Everybody has their personal attitude to risk, but it's crucial to accept.
That's
I mean,
helpful.
Sarah, can I just add that I think, you know, David's distinction between risk and volatility is really important, because just because something goes up and down in price doesn't mean you've lost, unless you're a forced seller. So, you know, don't equate risk and volatility the same. Just because it's volatile doesn't mean it's risky. And that leads on to another point, and that is of time horizons. I think you need to make sure in your mix of different assets in your savings, you are clear in your own mind as to what that particular asset is going to do. I mean, one of our colleagues talks about buckets, and they put clients' assets into 3 buckets. And they have a sort of very short-term bucket that is for day-to-day needs. They have a sort of more intermediate-term bucket that is for, you know, the needs over the next 12 months to 5 years, and then they have a long-term bucket. And, you know, the reality is that something that can be conventionally risky in the short term actually is low risk in the long term, and the converse is true, really. So you really need to make sure that you understand the difference between risk and volatility, but equally you match your time horizons for your expectations.
I really like that analogy of buckets. I have to say, I just told you that I've been saving money in COVID. Pre-COVID, my buckets had holes in them, people. I needed better buckets. It has to be said. Now, listen, we've had just one question at the moment, which I'm going to come to. Please, all of you listening and engaging today, give us some observations, give us some more questions. But I'm going to come to this question because it's really interesting, and it's something that I've been thinking about when I was talking about opportunity. Also, what it seems to me is there's some opportunity out there for really good mortgage deals, and everybody who's been locked down, and with the real estate market opening again, and you can move out, thank God, and you can go, you know, live with your new partner, or, you know, go buy that house you really wanted to buy, and, you know, the wheels of life are turning again in that way. So one of the things I wanted to talk to you about is the fact that is it the fact that mortgages are real opportunities right now, and to buy could be really safe. And one of our questions as well is, given interest rates are so dire, wouldn't we just be better off paying off our mortgages? David, why don't you try and address some of that for me?
Would you be better paying off your mortgage than having the money sitting in a bank? Long term, yes, you would, because the rate of interest you're getting at the bank is not as much as the level of interest you're paying the mortgage company. That's if you've got cash there in the long term. If it is long-term money, though, I mean, it shouldn't really be sitting in cash. There are better places to put it. There's another question, isn't there? That should you pay off your mortgage or should you invest money? And I think that comes back to the conversation we've just been having about risk, is that if you're prepared to accept the risk, then it's, given where interest rates are at the moment and mortgage rates are at the moment, there are good prospects for taking that money, investing it, and doing better than the return you'd get for paying off the mortgage. So, so don't leave money in cash long term. I mean, if you're too risk averse to invest the money, then yes, pay off a bit of the mortgage. But if you've got the appetite to invest the money, then we think that's a better way forward.
Okay, so we've had another question, and it's still on the theme of mortgages. So I'll stay with that, and I'll stay with you, David. So talking about mortgages, is it just as risky buying as first-time buyers if the market tanks leading to negative equity and debt?
Well, I suppose you're going to lose the same amount, aren't you? Whether an existing property or whether it's a new property. I suppose if it's a new property and you're in negative equity rather than just the value of your home falling, it's a lot more difficult to move. You're stuck there. So from that point of view, it's more risky. Yeah, I don't think I've got anything more to add to that.
No, that's fair enough. So you both, I think both of you talked about tax efficiency, and talk me through that a little bit. You know, when should clients look at tax efficiency? When does it matter? When do we need to focus on that? Richard, why don't you start us with that?
I think you always need to have a view to investing in the most tax efficient way. I mean, there's some great opportunities that the government give out, although they are taking them back. I mean, you need to maximise your use of your pensions. You need to use as much of your ISA allowances as you can. So those are, you know, really important things. And for people with larger sums of money, then there's some great work that our advisors do with offshore bonds. So I think, you know, that's all very, very important. I think for people who are thinking about inheritance, then there's a massive amount that needs to be taken into account when you're planning inheritance tax strategies that you know that can save your descendants anyway, certainly a huge amount of money. So I mean, tax is really, really important. It's a critical element in having the financial plan that, you know, we keep going on about. So, you know, a big element of that is making sure that once you've decided what you want to invest, you do it in a tax efficient way. So tax is important. I think you have to be a bit careful about being too driven by tax. There are certain places where you can make sure you don't pay tax ever, such as in an ISA. But in your general investment areas, you probably will have to pay some tax at some stage. And actually, the differential returns between equity markets and companies within those equity markets can actually quickly dwarf any tax bill you would pay. So I think there's an old frame: don't let the tax tail wag the dog. And I think we certainly regard that as an important consideration. But obviously, this is where having a financial planner working alongside your investment manager, as we do, is absolutely critical to making sure you get the right balance in any portfolio.
Thank you for that. And David, so I want you to be really objective when I ask you this question, okay? So how do you choose somebody to work with? And before you come on to that, it's not just about you. I know you're great, but it's not just about you. It's not all about you. But I feel personally there are lots of some of our contacts, some of our clients in our communities. There are lots of different, you know, financial houses and private banks, and everybody tells me their products are different and the way they do it is different and they do it better than the others. My view is it's about personality. It's about who you trust and who you get on with. So objectively speaking, how do you choose a planner?
How do you choose a financial planner? Well, there are some financial planners that specialise in certain areas. So it depends what you want advice on. Yeah, and you make sure that whoever you're choosing does advise on what you need the advice on. So you know, if you want retirement planning, make sure the advisor you're looking at covers that area and knows it inside out. Same with you know, if it's home equity release or later life planning, choose a specialist. Make sure that, or don't be afraid to ask questions, you know, even if they're difficult questions about charges and about qualifications. Make sure the advisor is appropriately qualified. There's a minimum, it's called level 4 qualifications that an advisor needs to have. A chartered financial planner is the gold standard, really. Ask family, ask friends, ask colleagues, because if you can get a recommendation, that's always good. But I think you've hit the nail on the head, really, Zara. It's got to be someone you trust, not necessarily someone who's nice, although I suppose that's a bonus, isn't it? But it's got to be someone who you trust to tell you sometimes what you don't want to hear. You know, if you are spending a bit too much, or if your plans are not on track, there's no point somebody telling you that they are. It's got to be someone who's prepared to take a stand and tell you you've got to change your spending habits or your saving habits.
That's good, thank you. And Richard, coming to you really, I mean, this is you're the chief exec of this company, and you talked to us at the beginning about how the company's client profile started off. What is the client profile like now? You know, who are you reaching out to, and why should people who are listening today perhaps consult you guys? Why you?
So we continue to focus our advisors by speciality. So our core business continues to be looking after the personal injury course protection area, markets, clients, and we are the biggest advisor to clients like that in the country, which means we've got the deepest knowledge, most sophisticated understanding, collection of leading industry experts in that particular area. And so for people who have that need, that misfortune to be in that particular position, then I mean, coming to somebody like Irwin Mitchell provides them with great reassurance and a level of service that you're not going to get anywhere else, because our team just are better than anybody else in terms of dealing with those kind of clients. I think looking at the broader general wealth area, there are clearly huge number of opportunities you can go there. But why would somebody come to Irwin Mitchell or IAM Asset Management as part of Irwin Mitchell? I think there's a variety of reasons for that. I think you're never going to get away from the fact that it matters how your personal chemistry is with the advisor. But there are many other really important considerations. So, for example, you're engaging in a long-term relationship, so you want to make sure that the company and the individual is going to be around there for the long term. So that you want to probably focus on a good quality, stable company that if anything goes wrong, they're going to be able to put it right for you. I think you want to make sure that they have a variety of services. I mean, David mentioned some, but there are lots and lots of other services that are important in your life. And actually, it's quite nice to be in one place for them. So obviously, we can provide financial advice, we can provide investment management, we can provide tax advice, but then broadening it out into the wider Irwin Mitchell family, then there are great opportunities for us to call on experts in tax and trusts. And I talked about estate planning. We've got estate planning experts. You yourselves are, if people need family law involvement, we've got that. We've got conveyancing, and so on and so forth. So we've got the full service of any kind of professional advice that an individual would need. It's not just about financial planning and investments. It's about providing individuals with a holistic service in one place that is joined up, so they don't have to worry about any gaps appearing in their provisions of whatever nature. So that's what I think is important.
Okay, so we've talked a lot today about the need for a financial plan, and I think what I'd like to know really, David, what, when and how do we do this financial plan? How do we actually start? If today I said, right, my finances are in a bit of a mess and I don't really know what I've got or what I haven't got, and I think it's the fear factor, isn't it? You don't know where to start. I don't want to have to get all my finances together and give you them all, because it's too blooming difficult in this environment as well. So how do you make it easy for somebody? What do we do? When do we do it? How do we do it? Give me that in a nice shortened version, just as people can kickstart this.
Well, I'll take the what first. So what is a financial plan? I suppose in its simplest form, it could just be a spreadsheet. It's just, you've got to sit down, work out what your objective is, your financial goal. So to take a simple example, if you want to retire at age 60 on 40 grand a year, you've got to work out how much you're going to save from now until age 60, and then work out how much you're going to spend and how long your money's going to last. So if your money lasts till age 90 or 100 at the rate you're currently saving, then that's probably enough. That will see you out. If your money only lasts to age 70, then something's got to change. You've either got to save more, or you've got to readjust your expectations. So a financial plan can be as simple as that. The clients that we see, it tends to be a lot more sophisticated, and the sort of how do clients do it? Quite often clients do just come in with a box of papers or a load of files and say, look, here's what I've got, help, sort it out for me. And it's a question of sifting through that, understand where clients are, what they currently have, and understand where they want to get to. And then just the plan really is a series of measures to get them there in the most tax efficient way. So the plan would say, okay, you've got to save X amount into ISAs, Y into pensions, and every year it's a question of meeting up and making sure that plan is on track. And when do you do it? Well, I think everyone should have a plan really, because it is the cause of stress and worry if you don't have one. I think. Sorry, I've lost.
No, don't worry. Don't worry. Listen, you know what I think as well, and from my personal point of view as a client, if you like. I mean, the way I did a financial plan was I literally sat down with my husband, had an amnesty, and said, you got to tell me what your debts are and whether there's any money and literally went, okay, this is how much we both earn. This is what property we've got and how much is in it. This is what's in the bank account. This is what the debt is. And then I thought about, well, what do we want to achieve? And I did some short-term goals first. So, for example, when we wanted to buy a house or extend our house, those are my short-term goals, what we needed money for. And then long-term, obviously, was retirement. But also, we've got a 2-year-old. So I thought about, well, I've got to save some money for university fees. And when I started out, when I was much younger than I am today, people, I literally thought, I'm going to put a little bit of money aside just for holidays. And then that grew into... my holiday pot became 2 pots. It was saving for a house as well as my holiday. And then it became 3 pots, buckets, as you said. I love the bucket analogy. But I think a lot of us have got leaky buckets. So, David, I completely understand where you were going with that. And I do think it's, when you're talking about a spreadsheet, I think just a blank piece of paper and sit down and write on it. This is what I've got. This is where I need to get to. And then don't worry about any further. I think they just need to put the phone to you. I think that's where they need to go. So. Listen, time is marching on, so people.
Sarah, can I just add though that I think people just do need to be aware of the fact that they actually are giving the government money that they shouldn't be doing. So, for example, by not maximising your pension, you are letting the government have more than they should do, because there's an allowance you should be taking advantage of there. Similarly, with not using your ISA allowance if you can. Why pay tax unnecessary? Well, because effectively that's what you are potentially doing if you're not maximising on your ISAs. So yes, the spreadsheet is really, really important, but I think it's critical that you actually are aware of the opportunities out there by talking to somebody like David.
Thank you, that's really helpful. And what we're going to do now is, because time is marching on, so if anybody's got any more questions, then please do put them up now, and don't leave before you fill in that feedback form, please. I think we're going to surmise, and why don't I go, David, why don't I go to you first? I mean, maximum of 3, minimum of 1 takeaways for people. If somebody's going to do something different today, what would be the key thing that you would say to them? Take this away today and action this today. What is your call to action?
Well, we've talked a lot, I think, about plans, the need for a financial plan. Get one. I mean, if you haven't got one, get one. It can be as simple as the ones we were talking about, or more sophisticated, but have a plan. The second thing I would say is, once you've got a plan, stick to it. Know where you're headed, and when times like this come along, don't get knocked off course. Just stick with the plan. You were talking earlier about regular investing, Zara, investing into your ISA. Keep doing it. Don't stop because the market's had a wobble. Know what your plan is, know it's long term, and keep doing it. And the third one, I suppose, is if you're not confident doing what you're doing, take advice. because it could end up costing you a lot more than the cost of the advice. I think they'd be my tips.
That's great. Go on, Richard.
So, I mean, I would emphasize taking advice, but I would say start early. Young people need to recognize that if they start in their 20s, even with a small amount of money, that can grow to be a very large amount of money by the time they reach their 60s. So, the evidence is overwhelming. The sooner you start, the less you actually have to put in. One of the 7 wonders of the world, or the 8th wonder of the world, is compound interest, and I think that really shouldn't be ignored. I think firstly, people need to make sure they match their time horizons with their investment strategies, such that if you don't want short-term and volatility, don't invest in equities. But if you want to save for the future, don't leave it in cash. And I guess thirdly, we think this is a great opportunity to invest in a whole range of financial assets at the moment. And one of the questions is now the time to pay off the mortgage. Not being an advisor, but my view is I wouldn't be paying off my mortgage now. I'd be investing in many of the opportunities out there.
Okay, thank you. So I'm going to tell everybody, for what it's worth, and I'm not a financial planner or financial advisor in any way, shape or form, what my takeaways would be. I think you should be honest with yourself in terms of your spending and be alive to it. So easy. You just don't open your bank statements or don't flick onto them on your email and you just ignore it. So have a look. However scary you think it'll be, actually, if you're honest with yourself, that can make a difference. I think, I'm not going to say have a plan, but I'm going to say have a planner. I think you definitely contact you guys, definitely speak to people, maybe speak to 2 or 3 people and find the person that you're comfortable with. I think that's really important, because taking it away from yourself is really important. But the last thing for me is have a dream, people. Have a dream, because then you can save towards that dream. So whether that be, if your goal is to have a year off and travel the world, if it's to fly to Australia, if it's to buy a house, if it's to save really well and retire early, have a dream and fulfill your dream is what I would say. So I want to say thank you very much to our guests today. You've both been great, and that's been incredibly informative. So thank you both very, very much for your time and trouble today. If anybody has questions that they haven't asked today and want to contact any of the guys direct, the screen is up there showing our email addresses to any of us. If you've got questions, please feel free to ask questions. Also go to our Irwin Mitchell website. We've got a Corona hub set up there with loads of really interesting information and guidance which would be useful to you, so please do look at that. We like to cover topics that are interesting to you guys out there, so if there's something that you think you would love to hear from us about, it could be anything, literally anything. It doesn't need to be legal. We've been hosting a lot of webinars and getting independent outside experts to come on and talk to us, so if there's something you want to hear about, email us, and the email address is up there right now. So please fill in the free feedback form. Enjoy the rest of your Friday, and it's the weekend, people. The sun is going to shine. So thank you so much for joining us today. Take care.